He who does not think about the future has no present.
The world reached a peak in aggregate public debt in 2020.
When this two-tier model of the banking system was created, the function of creating new money was entirely handed over to commercial banks.
The additional debt is being transformed into real added value and sustainable high growth, from which society can continue to take resources.
Monopoly is not always a bad thing. The police should be privatized. We're unlikely to arrive at any good outcome.
The sector is subject to very tough competition, and the question is whether we want to replace this with the central bank monopoly?
Absolutely not. That's definitely not the case.
People have traditionally believed that the financial system relies heavily on banks. However, this system can be intricate. Wouldn't it be simpler to replace it with a more primitive system, so to speak, with a single central bank digital currency, and everything suddenly could become simple? And the report raises the question of transitioning to a new financial infrastructure.
The Open Dialogue is an international project that brings together experts, analysts, and people from around the world to understand where humanity is heading. The second cycle of the project's report is dedicated to key megatrends that are already changing the world. The authors note the breakdown of the previous model of globalization, the transformation of the financial system, and rapid technological development. Demographic changes and new technologies are transforming labor markets, social institutions, and the very notion of sovereignty. In the new reality, human capital, the ability of a person to learn, adapt, and realize their potential, becomes the most important resource. But any forecast is not the final answer. This is an invitation to the open dialogue.
Alexandr, who has joined us, as I understand, holds the view that there is no necessity to maintain the old system, as there is great potential for its use. Ring our discussions regarding both the report and the essay, Alexandr mentioned that the primary objective is economic growth. This is indeed the most crucial issue.
From an economic point of view, the main task is not economic growth, but the well-being of people.
But we haven't gotten to the discussion yet. Alexandr, did I accurately convey the main points, and what changes should be made to the current financial system? I'd like to thank the Trim Center of Expertise for this report. Of course, it's rare to see such a long-term view on the future of the financial system, and the key trends all gathered in one place that will likely shape its development and transformation over the next 5 to 10 years. Nevertheless, I have 3 comments on the report. The first is a criticism of the traditional financial system. In other words, what the report calls the traditional financial system is a 2-tier system, where the central bank is at the top, which manages, first of all, the rules, and secondly, the liquidity. And below it lies a system of commercial banks that, in fact, allocate capital and credit across sectors of the economy. It is opposed by a promising financial system that appears to be single-tiered. That is, the central bank plays the leading role in it, performs all functions, while on its periphery are agents, that is, certain small financial entities that perform certain functions as its agents. If you look at the background of the financial sector and the finance, a long global background, then these names are quite successful. The single-tier financial systems described in the report are very similar to proto-ancient systems, agency systems, where central banks were not even formally separated from the Treasury or the Ministry of Finance. Their primary function was precisely to create what was then physical money, apparently in the promising system of digital money, and on their periphery were payment agents and literally those small entities that carried out simple processing functions. In the 17th century, a merchant at the Nizhny Novgorod fair would have recognized this single-tier financial system as quite familiar. He wouldn't have had to explain too much about what it is. What would come as a surprise to him would be the current, more complex 2-tier financial system with banks inside it. I think that what we call the traditional financial system would be better described as the contemporary financial system. We owe to it many innovations in the financial products market, the development of the capital market and derivative financial instruments, and, most importantly, the reduction in the cost of all these transactions. This is a more cutting-edge version of the system, and I believe it is also more efficient than a single-tier financial system. The second point that struck me as valid, though it also raises questions for me, is the report's focus on debt. Of course, the levels of public, corporate, and household debt are rising. Over the last years, the cost of servicing that debt has also been rising. It's a new trend that didn't exist 5 years ago. We used to talk about zero interest rates. On the other hand, the growth of this debt itself and of interest rates, I think, is a symptom rather than a challenge. And it is not the main criterion by which we should evaluate the quality or efficiency of financial systems. The main goal of the financial system is to finance growth, sustainable, high growth that provides states with the resources to ensure the security of social systems, which changes our lives and raises the level of well-being of people. We see that China is growing and continues to grow at a rate of 5%. The US grew by 2%, and for an economy worth 330 trillion, that represents 600 billion in new value added. In other words, this additional debt is being transformed into real added value and sustainable, high growth, from which society can continue to take resources. A minor comment, essentially, regarding the section on debt, is that the reader might get the impression that we are on an unstable, explosive path of debt growth, an unstable trajectory. In fact, the report's own data shows that this is not actually the case. The world reached a peak in aggregate public debt in 2020, due to a large fiscal stimulus and very loose credit conditions. Since then, over the past 5 years, the global debt level has been declining. The last and the most important point I'd like to make, and this is entirely my personal opinion, but it seems to me that the report's optimism regarding central bank digital currencies is unfounded. My impression is that central bank digital currencies are a solution that is trying to find a problem, to find a challenge to solve.
We have an idea, and we're trying to find a challenge that fits it. To be fair, it should be said that this challenge did exist. If we go back to the very beginning, to 2020, when the idea of digital money first emerged, it had an application. I think there were 3 main motivating factors or incentives. The first is epidemiology, when cash raised concerns about how to handle it. It seemed like we needed some kind of digital alternative that would help us avoid this epidemiological risk. The second challenge concerns it. Central banks were concerned about competition from what they called money substitutes, crypto, stablecoins, and so on. Central banks felt that they needed to immediately offer a state-run alternative to these money substitutes. Third, and this is also extremely important, when central banks conceived the idea of digital currencies, and the interest rates were zero and negative in real terms. The idea that businesses and households would keep a significant part of their savings, the liquid part of their savings, at zero interest rates in digital currencies seemed plausible. It did not raise any questions. In today's global economy, where real interest rates are positive almost everywhere, it's quite difficult to expect the private sector to have significant demand for an asset with a zero yield, given the real rates that are, in our case, double-digit. Therefore, I believe the transformative effect of central bank digital currencies could have materialized if the idea itself had been implemented very quickly. 6 years have passed and have a huge number of theoretical literature and papers on how we will manage central bank digital currencies, and there are even prototypes, but there is simply no widespread use that would allow us to come to conclusion that they bring in practice the benefits that central banks were counting on.
As the classics of economic science have said, any institution is both a bee and locust. That is, it brings some benefit, but in order to eat well and live well. No institution succeeds for the sake of some common good. They exist, first and foremost, for their own sake. And we must ask ourselves, what about this financial system that surrounds us today, which serves as the backbone of both the global economy and our country's economy? Is it more like a bee or more like a locust? Really? Because if you look at the report, it provides figures on how much the American financial system and the Russian financial system of the economy cost. We understand that the financial system has 2 main functions. intermediation, and the function of managing the allocation of capital and the distribution of capital in the economy. If capital is allocated efficiently, the economy grows faster, there is more room for improving people's quality of life and increasing their well-being. So what we've been observing lately in that, indeed, the financial system is increasingly functioning and behaving like a locust. Yes, I always ask myself this question, especially as someone who used to work in banking. What exactly do bankers do that they should earn several times more than engineers, doctors, and other highly qualified specialists? Therefore, the first question, the first point, is that if the financial system does not change, does not transform, then it is doomed to die in the form in which it exists. It is very expensive and places a very heavy burden on the economy. The costs of its operation are very high for the economic system. The second point, which relates to debt. Here's the background to this. When this two-tier model of the banking system was created, the function of creating new money, or let's say printing new money, was entirely handed over to commercial banks. And an indirect consequence of this function is that for the long-term development of the economy, it is necessary to issue loans to the private sector, the public sector, that is, this is one of the basic sources of growth of the money supply and expansion of economic activity in general. And in the current model, without new loan or economic expansion, it is simply impossible to achieve self-identification. However, this mechanism has very serious problems. Debt always has a downside. This is an asset. In other words, if someone has a debt on one side, someone else must be accumulating assets. And we see that the creation of money in this way leads to a long-term stratification of society, that is, one part of society accumulates assets, while another part of society, including the state, accumulates debt obligations. This very seriously changes the long-term structure of income. Therefore, it's obvious that a financial system which, on the one hand, imposes very high costs on the functioning of economies and, on the other hand, leads to a very serious social stratification, polarization of society, and other challenges, it is simply an unsustainable structure. It cannot last forever, and clearly something should replace it. The question is, what will replace it? What are the distinctive specifics of central banks' digital tools? The fact that it brings the money-making monopoly back to the government level. And it means that the money-making is possible without asset stratification. It's a completely different approach, and it's clear that this function is being addressed. It's obvious that the government won't be able to handle the function of capital allocation on its own. Here, this system only works when such decisions are made at lower levels, within the private sector. Some people assess credit risks, whereas others analyze the potential for shareholder returns in specific sectors, making decisions and assuming responsibility for the allocation of financial resources. However, the ongoing development of central banks' digital currencies may facilitate this process. But I repeat once again, the main problem is not the new tools. It refers to that the old tools have become too expensive and are already leading to irreversible consequences for society. The polarization we see on the political spectrum is largely a consequence of how the financial system operates. That is the problem, and the solution should be found. It is an issue that the open dialogue will need to address in the future.
I would like to agree that the most part of the points are entirely correct. The sustainability of a system is determined by its efficiency. An inefficient system does not survive. It is not some kind of specifics of the financial sector. This is a specific of any sector, of which there were enough, and which are no longer with us, simply because they did not survive, because they turned out to be less effective. Is the financial sector is facing with competitive pressure? Of course, it's true. As for me, I'd like to separate a few points here. First of all, the central bank can play a much more active role in managing credit flows and providing savings instruments without digital money. This is, in principle, already possible using current methods.
Why should the central bank interfere in the credit management process in terms of who the specific borrower is, what kind of loan they should receive, and under what conditions? It seems to me that this is something that should remain at the level of the private economy in any case.
In principle, examples of direct accounts held by the public at the central bank do exist in the contemporary history of Eastern Europe. In some central banks in Eastern Europe, it was possible for a household to open an account at the central bank before the banking sector matured. The equivalent of this in the Soviet Union was the ability to open an account in the USSR savings bank and have, in essence, the equivalent of, perhaps, not a digital ruble,
but a direct account on the state balance sheet. Second, the problem of inequality is one of the most crucial problems, in my opinion, of the long-term sustainability of the state, justice, the social system, and so on. What worries me is that we often underestimate how much these challenges lie outside the financial system and try to look at the financial system to solve problems that are related to industrial policy, growth, productivity, competitiveness, and so on. A significant portion of the issues surrounding equal distribution of income are tax system issues that will not go away with the creation of central bank digital money.
It's clear that the problem of inequality, and here I absolutely agree, is much broader. But I'd like to say once again, the problem is as follows: the two-tier banking system and that model, it has not existed in the world as a whole for a very long time. This is essentially how much there is that could be, maybe a little more.
The phenomenon of economic growth has also about 200 years old at most.
As long as your overall debt level in the economy is relatively low, it's not that noticeable. And it's clear that this system had the greatest possible effect at the very beginning, but now, when I'm talking not just about the government debt, I'm referring to the debt as a whole, when either the states must necessarily borrow or the private sector must necessarily borrow, it means that this growth of the active component of the balance sheet is very serious.
So I'd like to ask Elena Veryovochkina, who authored a separate essay on the role of the central bank and digital currencies. Elena, if you would be so kind, please direct your question to both speakers at once.
Don't we consider financial market monopoly, or any form of monopoly, to be a utopia? Even with the presence of technological advancements like blockchain, smart contracts, distributed ledgers, and digital assets, technologies that enable the central bank to not only perform mega-regulation, but also to establish itself as a mega-monopolist in this market. So, I contend that under all circumstances, we need to distance ourselves from any form of monopoly as far as we can.
Yes, well, actually, I agree in many respects. A monopoly is not always a bad thing. Now, I'll talk about these points. A monopoly is often a symbol of inefficiency, a symbol of problems, and so on. In this regard, motivation, we talked about this in the first part of our discussion, should be maintained among economic agents. If they lose this motivation, and there will be no forward movements in this regard, at all levels of the economic system, of course, motivation should be maintained. But the first thesis is that there are areas where the absence of a monopoly would be a major challenge. For example, a state monopoly on the use of force. Let's say we argue the monopolies are bad. If we take that to the extreme, that the police should be privatized and military should be privatized, we're unlikely to arrive at any good outcome. And the second challenge, monopolies in the private sector. If the main risk of government monopoly is inefficiency, then the main risk of a private monopoly is first and foremost abuse of power and the concentration of profits in the hands of the monopolist. We're talking about the fact that at this very moment, private banks hold a monopoly on the issue of a new money. That is a fact. It's reality where both Russia and other countries have been living for the past several decades. And we ask ourselves, is this monopoly good? Does the level of income in the financial sector correspond to a contribution people make to the development of the economy? Yes, it's clear that this contribution is very important. Yes, it's clear that the decisions they make in terms of capital allocation and financing of certain projects are always very important decisions. But do they determine such a disparity in income? Therefore, this question of division, who should do what and how much they should receive from it from the economic income created in society? This is the question that will need to be answered.
I'll just add a few words. I completely agree that it's important to define the boundaries of a monopoly. For example, there is a rational monopoly when the central bank sets the key policy rate. This decision applies to the whole sector, to the whole economy. It is a monopolistic decision. It is not some kind of private sector consensus. It's important to understand, I think, that we're calling the banking sector's current ability to issue money a monopoly here, whereas I completely agree that the sector is not just in competition, but in fierce competition for every client, for every decision, and for every minute spent on an application. In other words, this sector is subject to very tough competition, and the question is whether we want to replace this with the central bank monopoly.
Absolutely not. That's definitely not the case, because once again we see that the Russian financial sector is truly one of the most convenient and user-friendly, and has created some of the best services. And it's clear that those who create such services should be highly paid specialists, because it improves people's life dramatically, isn't it? And that's really great, we definitely need to keep it. The question is that, in addition to this function of the B, as I said at the beginning, there is not a very important function of the locust. So we should find an approach where the B function remains while we curb and reduce the locust function.